The Minority Market. Episode 53. Recognizing Emotional Triggers in Trading. Every trader and investor is controlled by invisible triggers. These triggers activate emotional reactions that influence decisions without conscious awareness. Most people do not realize when emotions take control. The minority learns to identify these triggers early and neutralize their impact. Emotional triggers are events or thoughts that create automatic reactions. A sudden price drop, a missed opportunity, a friend posting profits, a news headline, a losing streak. These situations activate fear, greed, frustration, or excitement. The first step toward mastery is awareness. You cannot control what you do not recognize. Most people react first and think later. The minority thinks first and reacts slowly. Let us talk about fear triggers. Fear often appears when price moves against a position. The mind immediately imagines worst-case scenarios. Capital loss, failure, embarrassment. This fear pushes people to exit too early or panic sell. Another fear trigger is market crashes. Red screens, negative news, and falling indices create collective panic. The minority trains themselves to slow down during high-fear environments. They avoid emotional selling. They focus on long-term perspective and structured analysis. Now let us talk about greed triggers. Greed appears when prices rise rapidly. Watching profits increase creates excitement and overconfidence. This often leads to increasing position size, ignoring exit rules, or holding too long without risk management. Greed is also triggered by stories of quick wealth, social media screenshots, influencer success stories, viral trading content. These distort reality and create unrealistic expectations. Another major trigger is regret. Missing a rally creates emotional pain. This regret pushes people into chasing price at bad levels. They enter late. They abandon discipline. The minority accepts missed opportunities as part of the process. Let us talk about revenge trading triggers. After a loss, the emotional desire to recover money quickly becomes strong. This triggers impulsive entries. Position size increases. Discipline disappears. This cycle creates deeper drawdowns. The minority identifies this emotional state early. They pause trading activity after losses. They reduce risk. They step away to regain clarity. Another trigger is boredom. When nothing happens, people create activity. They enter low-quality trades to feel productive. The minority recognizes boredom as a signal to remain inactive, not to force action. There are also social triggers. Watching others make money creates comparison. This creates pressure. It damages patience. It pushes people into risky decisions. The minority avoids excessive comparison. They focus on their own plan. Another important trigger is ego. Ego wants to be right. It resists accepting mistakes. It holds losing positions too long. It refuses to exit. Recognizing ego-driven behavior is critical. Let us discuss physical triggers. Lack of sleep, hunger, stress, fatigue. These weaken emotional control. When physical health drops, emotional reactions increase. The minority protects physical routines because mental stability depends on physical stability. Now, let us talk about how to detect triggers. One method is observing body signals. Fast heartbeat, tight chest, rapid breathing, sweaty palms. These physical signals appear before impulsive actions. Recognizing them gives time to pause. Another method is tracking thoughts. Sudden urgency, desire to recover losses, fear of missing out, desire to prove something. These thought patterns reveal emotional triggers. Journaling is one of the most powerful tools. Writing emotional reactions after trades creates awareness. Over time, repeated patterns become visible. This allows correction. The minority builds trigger awareness through repetition. Every mistake becomes data. Every emotional reaction becomes a learning opportunity. Another important skill is creating trigger response rules. For example, after 2 consecutive losses, stop trading. After emotional stress, Reduce position size. After big wins, avoid increasing risk. These rules protect discipline. Let us talk about environment control. Remove unnecessary emotional stimulation. Reduce social media exposure. Limit news consumption. Create quiet working conditions. These reduce trigger frequency. Triggers are unavoidable. Markets will always provoke emotion. The goal is not to eliminate triggers. The goal is to respond calmly. Professional behavior is measured by response quality, not emotional absence. Over time, trigger awareness becomes automatic. You start recognizing emotional patterns instantly. This creates emotional intelligence. When you control triggers, you control behavior. When you control behavior, you protect capital. When you protect capital, compounding becomes possible. The majority is controlled by emotional triggers. The minority observes them. They pause. They choose discipline. This is not easy, but it is trainable. And this training separates consistent performers from emotional gamblers. Because in the market, the person who controls reactions controls outcomes.